Hello again, everyone. It's Gene Ahrensberg. I'm coming to you on Sunday, June 10th, 2012. Well, gold gave back 1.9% this week on the Bernanke disappointment. He didn't say the right thing on Thursday, while silver was exactly flat. Looking a little further down, mining shares slightly outperformed the metals, with the Gold Bugs Index off less than 0.5%, and the Canadian Venture Exchange just north of flat, and the star this week is the Market Vectors Junior Gold Miners Index, up 1.2%. Notice just below that on the closing table that the US dollar index actually fell this week. You know, if the dollar can't rise against the euro in this environment, what does that say about the dollar? Now, today's video is kind of an update to our May 28th look at the CFTC Commitments of Traders reports. So those that haven't seen that video might want to take a look at it first. But let's get started with the COT report, the legacy COT report. What we're looking at here is the data for the large commercials in the COT report. And as gold rose $61.80 or 4% to $1,616, that's Tuesday to Tuesday, the COT week. The combined commercial traders in the legacy COT increased their collective net short positioning by a large 25,413 contracts. That's 19.4%. And so they're showing 156,122 contracts net short as the open interest increased by a much smaller 3,950 to 423,000 and change contracts open. So we got gold going higher, and the commercials apparently showing material opposition. Now, this is the graph for the large commercial net short position, or the LCNS. The legacy COT combines some traders which are now separated by the disaggregated COT report, or the DCOT. It includes, in the commercial category, the producer merchants and the swap dealers, and perhaps some of the other reportables as a single group. Now, we compare the LCNS to the total open interest. We call that the LCNS-TO, or the relative commercial net short position. And we think that helps us to see how aggressive the hedgers are positioning. If the combined commercial net short position is a large portion of the total open interest, it tells us that the hedgers feel the need to protect their long metal positions or inventory aggressively, and vice versa. In general, a high level of hedging means that the trade, the industry, sees more risk of lower prices and vice versa. So, a low level of net hedging means the trade, the industry, is not fearful of much lower prices, and it's therefore usually contrary bullish. Now, let that idea be the guidepost for why we look at, study, and compare the positioning of the largest futures traders in the world. When the big hedgers are a low percentage of the open interest net short, like they are now, it means they see and have positioned for less downside in gold. And as of Tuesday, June 5, the LCNS-TO for gold rose from a very low 31.1% up to 36.8% of all COMEX contracts open. That's higher, to be sure, but it is still quite low on the graph. One COT week ago, the relative net short position stood at its lowest since November 18, 2008. It was 24.6% then, with $738 gold. As gold jumped big, it ran into apparent heavy opposition because the LCNS increased by 25,000 contracts. So we've got gold in the $1,616 arena, and the combined commercial traders were willing to increase their net short positioning in both nominal terms and as a percentage of the open interest. But neither have risen to the point where we think of them as being bearish or in the warning zone. Let's take a look at silver. Okay, once again, we're looking at the large commercials in silver futures. And as silver rose 68 cents or 2.4% to $28.50 Tuesday to Tuesday, the combined commercial traders in the legacy COT report increased their collective net short positioning by 2,191 contracts or 15.3% from a near decade low of 14,334 contracts to a higher but still exceedingly low 16,525 contracts net short, as the open interest increased by 2,848 lots to 116,809 5,000-ounce contracts open. So we've got silver modestly higher, but the commercial's apparently willing to fade the modest bump higher in price. So despite the increase, the silver LCNS remains very near the decade lows set December 27th of last year, 14,132 contracts net short then with $28.67 silver. And despite the apparent short-term opposition, the COMEX commercial traders do not have a large net short position for silver futures in nominal terms. Like we do with gold, we compare the silver LCNS with the open interest. We call that the LCNSTO. We think that gives us insight as to whether the combined commercial hedgers are being aggressive or not. When they are aggressive, the LCNSTO is higher, and when they are not being aggressive, it is lower. At least that's the theory. Let's look at the graph. This is the LCNSTO for silver, and we can also call that the relative commercial net short position, the commercial net short position relative to the total open interest. And so, the well-connected, best-funded, and presumably best-informed commercial traders in silver futures net short position, is toward the lower limits of this measuring stick. So we can say they're not being aggressive on the net short side with $28 silver. In fact, one COT reporting week ago, on May 29th, this indicator reached a new decade low, actually an 11-year low, of a tiny 12.6% with $27.82 silver. Not since July 17 of 2001 can we find a time when the combined commercial net short positioning was lower as a percentage of the open interest. The LCNSTO was 10% then with $4.22 silver. So the current LCNSTO, which we think is a measure of how much the big hedgers think silver is vulnerable to the downside, has not been this low for a decade or more. The big hedgers are not positioned as though they believe silver is going to plunge. And isn't that the very same thing as saying that the largest, best funded, and presumably the best informed commercial silver futures traders are actually positioning for higher, not lower silver prices? Now, the LCNSTO is not an infallible indicator. We can go back in time and find instances where a low ebb for the LCNSTO does not correspond with a turning low for silver. The only problem is that not one of those instances have occurred since the gold and silver bull markets began this time. Of course, there's no guarantee that this indicator or the big hedgers are right in their positioning, but one thing is crystal clear to us here at Got Gold Report. We would definitely not be shorting this market with an LCNSTO anywhere near this range. To be short now means that one has to believe that the relationship which has existed between the LCNSTO and the price of silver for more than 11 years is about to end. Bottom line for this segment: the legacy COT is more bullish than bearish for both gold and silver from a contrary point of view, but let's look a little deeper into some of the inside details. We track lots of charts in the DCOT, but for today let's concentrate on the short positions for the bigger spec traders and see if they're telling us something interesting. First, it's helpful to remember what occurred in gold since our last update 2 weeks ago. Remember, it was on June 1 when the market earthquake occurred. That was the dismal jobs number. Gold spiked up $64 and then more or less ran into a wall of opposition there. The one attempt to break out of that plateau was repelled on June 6th, one day ahead of Dr. Bernanke's testimony on Capitol Hill. So the only point we want to make here is that the COT reports reflect the surge higher, but not the Thursday correction, because the COT report cuts off on Tuesday. And with that big $64 spike higher on June 1, we expected to see quite a bit of short covering. So let's look again at the graph of just the managed money short positions for gold. Well, how about that? Gold pops 4% or $64, but the big funds only reduced their pure shorts by 5,236 contracts, or 12.8%, to a still sky-high 35,621 short contracts. Remember, we believe managed money uses short contracts to hedge their longer-term long positions, and so once gold begins a rally, their very high short position represents significant buying power and rally fuel. Now, this modest decline in the short position for the managed money traders tells us a couple of things. Firstly, it tells us that managed money was not panicked out of most of their short positions in the big pop for gold. It says they figured they'd get another dip to work with to start removing those short positions, and they sure did, didn't they? Either that, or it tells us that the normally net long funds are turning less bullish on gold. If that is so, then the large short positions held by the specs would stay and grow while they remove long positions. Instead of the shorts being a hedge to hedge their longs, the shorts would be the new larger spec position, and the longs would be dropping on price rises. If the funds believed that gold had entered a new bear market, we can bet they'd try to be right there in front of it. The thing is, we don't believe that for a minute. We remain convinced that the big funds are using their overly large shorts as a hedge to their longer-term long positions. And if we had to guess, we would guess that the hedge funds, the commodity trading advisors, and others classed as managed money as a group are probably using the current pullback to decrease their short exposure given all of the powerfully bullish fundamentals, the significant physical metal offtake happening in Asia now, and all the heavy money printing by central banks that has already occurred. Now, along those same lines, let's take a look at the silver disaggregated COT report. Now, we're recording this on Sunday evening, and Asia is already open, and you can see that silver has gapped higher. Silver saw a more subdued rise than gold on June 1. It also saw an attempted breakout above the $29.50 resistance on June 6th, only to run into the same opposition then just ahead of Dr. Bernanke's testimony Thursday the 7th. Silver has corrected back to about where it moved up to on Jobs Friday. So the data we're about to view occurred as of June 5 on the price graph, courtesy of Finviz.com. Now first, let's look at the managed money short position for silver, just their short position, like we did with gold. Now remember that the funds held as of Tuesday, May 29, the largest pure short position for silver futures, 14,596 shorts, since September 11 of 2007. That's off this chart, but it was 14,598 shorts then, just 2 contracts higher, with $12.57 silver. Incidentally, the largest pure short position for the managed money traders in the entire DCOT data set occurred the previous week, September 4th, 2007, at 14,765 contracts short. So you can see that the managed money traders are very close to their all-time high short position for silver futures. Now remember also that managed money is close to flat silver futures, less than 5,000 contracts net long, but they got there by increasing their shorts more than selling out of their long contracts, especially over the last couple of months. Let's take a look at the managed money net position in silver futures. And just like with the legacy COT, the managed money net position for silver is very close to the lower limits of the chart. Incidentally, the absolute lowest net long silver position for managed money traders in our records was actually a tiny net short position of 92 contracts on September 4th of 2007, with silver then at $12.09. Take a look at that rally which occurred right after that tiny net short position for managed money traders in 2007. Right or wrong, win or lose, when the big specs or big funds are at very low levels of net longness on that graph, the correct bet is to bet on higher, not lower silver prices. At least that's what the graph suggests. In simple to understand Texas terminology, when the blue line in that graph is at the lowest levels on the graph, there's a lot more bull-side horsepower than the opposite for silver futures. And now back to the managed money short position graph. So when we consider that the specs, the speculative traders, the usually net long specs, are holding short positions near record highs today, that represents to us a double helping of long side firepower waiting for the right signal to be deployed. And what about their opposition? What about the big dealers and the big bullion banks? Well, most of that class of trader is contained in this graph. The traders, the CFTC classes, is producer, merchant, processor, and user, which includes the largest bullion dealers, refiners, and bullion banks. Their positioning is always net short, so the position shows as a negative number on this graph. So when the blue line is falling, the producer merchants are becoming more net short and vice versa. And as you can see, the producer merchants are not very far from their lowest net short positioning in silver futures since the 2008 panic. Also included in the commercial category, that's the commercial of the legacy COT report, are the mercenary swap dealer traders, which apparently see more upside to the price of silver than their bullion bank counterparts. Let's take a look. As of June 5, the swap dealers reported a net long position of 16,917 contracts, down 1,035 from the previous week, but still within a couple thousand contracts of the highest net long position in our records for the swap dealers. By the way, that was on December 27, 2011, and they were net long 18,787 lots then with $28.67 silver. So what does stirring the disaggregated COT report entrails say? In a single sentence, we think the DCOT is very strongly bullish for silver in a contrary sense. The COT and the DCOT data is one reason we have chosen to take new long positions in gold, silver, and mining shares as of this past week. Naturally, we have done so with what we think are appropriate new trading stops and targets. But be sure to note our comments on the individual charts themselves. In fact, let's use our remaining time on those daily charts. We'll use the subscriber pages to launch to those charts. First stop, let's go to the 1-year daily gold chart. Now, subscribers can spend all the time they want. All we want to do is point out that gold took several spike shots at trying to break support in the green and couldn't break, and then it of course rose sharply on June the 1st. We took our position on the pullback on June 6th at $1,618. Originally we were only willing to risk 3%, but now after viewing the COT, we think we'll add once and only once if the trading gods are so benevolent as to give us a dip down to the 1540s. Or better, let's take a look at silver. Now this is the daily chart for silver, and it's kind of the same story as gold. We've taken a half tranche. We'll probably add to that half tranche on a dip to the 26 handle, or maybe a low 27 handle. And we may add the other half of the tranche after a convincing breakout above that channel. Last stop is the GDXJ, the Market Vectors Junior Gold Miners ETF, and you can see we've taken our half tranche on the pullback after the breakout attempt, and we'll probably add to it on a minor pullback or on a further breakout. So that's it for this video for June the 10th of 2012. We hope you found it informative, and I do want to say that I'm still kind of learning my way through the video format, and it's getting a little bit more fun, but it is harder than it looks. So bear with us. We'll try to do the best we can as we go forward. Bye for now.